Hello, everyone, and Happy New Year. Welcome to 2023. We've come into 2023 in a pretty quiet and boring fashion, to be perfectly honest. What we're going to be covering today is how the digital asset market really went to sleep over the break. And I, for one, am not too mad because it actually gave me a bit of time to rest, recharge, and rethink about what's going on in the space. So what we're going to talk about today is a very, very quiet patch of volatility, and this is both in the markets, so the pricing, but also on the chains themselves. It was a very, very quiet December, historically quiet, in fact, and really, we generally see these events precede fairly explosive moves. So it looks like 2023 is setting up to be pretty wild straight out the gate. So as I mentioned, it opened up the new year in a very, very quiet manner. We're going to be looking at a very, very low level of volatility and some of the metrics we can do to actually explain and track these, and also look for periods of time using Workbench to identify where we've seen similar levels of volatility. We've got some really clever functions in here that can really help with the visualization of these events. We're going to look at the very quiet on-chain activity for both Bitcoin and Ethereum. Both chains are very, very quiet at this point in time across almost all angles. So we're going to explore that from a few different places. And we're also going to look at the collapse of volume, especially with it relate to $10 million plus sizes. These are institutional whale-sized capital flows. And there's some very interesting dynamics going on that we'll explore in a bit of detail. And what we'll close out with is a drawdown in the realized cap. And I want to spend a bit of time explaining what the realized cap is, why it's such a powerful metric, and also exploring a new implementation or a concept that we can use to probably better track dominance within these markets, really based on the realized cap and taking out some of the challenges that we see with market cap based calculations. So just before we get started, and as usual, please do give us a rate, a share, and a subscribe. It really does help this channel. And for the new year, if I could really ask you just to let me know in the comments a few things. If there's particular topics or ideas or concepts you want more depth or more explanation on, please do let me know in the comments what you're looking for so I can really help you understand more about it. And bonus points, if you do happen to have a Glassnode subscription, whether you use it on the free plan or you have a paid plan, letting me know that as well really gives me a lot of insight, because what I'm trying to do in this season, me and my team are really going to try and expand more content, especially for folks who are paying attention, which if you're watching these videos, generally speaking, you are. So what we're looking for is just a bit more insight to understand how you guys are using the platform, what topics and concepts you need a little bit more detail explained on, because that really helps us tailor the content to make sure that you're getting the maximum value and that we're focusing in the right place to help you out. So please do let me know those. I do read all the comments, so please let me know, and let's get stuck into the analysis. Okay, here we are in our week 2 dashboard for the week on chain. And as you can see, almost just visually from looking at this price chart, this is all nice and volatile, up, down, up, down, up, down, and then stable coin. Now, quite remarkably, Bitcoin has essentially been trading within, if you can believe it, since the 17th of December, within about a $550 range. This is just 3.4% for just shy of a month. It really is quite remarkable, and there are very few instances in history where Bitcoin and any digital asset really goes to sleep to this level on a volatility framework. So really, it's been a very, very quiet break. We do actually see this over Christmas breaks generally. At the end of the year, markets tend to go a lot quieter, not just in digital assets, but traditional markets as well. And clearly, Bitcoin and Ethereum were no exception in this instance. Now, what we have here are two really interesting workbench charts. Now, for anybody who's really in the weeds, actually playing around with these charts, you can always open up using a little magnifying glass. You can actually see these within Workbench. So you'll find a description to this dashboard, or a link to this dashboard in the description below. And you can always open up these charts to actually inspect how we've built them, look at the different functions that we're using. Now, what we're looking at here is this light blue curve is mapping out the current value of the orange, and the orange is looking at the monthly volatility. How volatile has Bitcoin been? How volatile has Ethereum been? So what we're doing is we're looking at the current value of that, and then we've used an if-then statement to highlight for Bitcoin in blue and for Ethereum in orange periods of time where the volatility was less than our current level. And as you can see, there really aren't many instances. Now for Bitcoin back here in 2015, it was quite volatile on a intraday basis, right? We're seeing the market still recovering from the bear market. We get these peaks and then 50% pullbacks, but generally speaking, it goes quite quiet before very significant moves. Back here in November 2018, for both Bitcoin and for Ethereum, price was trading into this apex of this triangle, and then we saw over the course of 1 month, I was here for both the sell-off and the rally here in April, this cut the whole price in half. The whole market fell by over 50% in just 1 month. And conversely, here in April 2019, April Fool's Day actually, we were essentially traded from 4,000 up to 14,000 in a matter of about 3 months. So generally speaking, low volatility precedes high volatility. And as we can see here, it can actually trade in both directions. So it's almost a little bit about put the seatbelt on, because there are historical examples of it going both ways. And you can also see following the COVID collapse, we had a bit of a recovery. The market went pretty quiet, and we actually then had the 2020 to 21 bull market. So as you can see, it generally precedes high volatility moves with examples in both directions. Now, moving into the on-chain space, we're going to start with Bitcoin, then we'll jump over to Ethereum. And what we're looking at here is a fairly quiet and somewhat lackluster on-chain activity space. So this first metric is called new address momentum. And what we care about here is how active is the network. We're looking at all the new addresses coming in on chain. And what we really care about here is not the absolute value, but where is the yearly average in blue relative to the monthly average. Positive momentum means our monthly is above our yearly, and negative momentum is the other way around. And what this is just telling us is, do we have the monthly activity that's currently happening? Is it growing relative to the yearly? So you can see back here in 2018, we actually got a nice break back above, and it actually remained there. Even though price was a little bit bearish through 2019 and 2020, we still had growing momentum. The monthly activity still exceeded the yearly, and that actually was indicating that there was a bit more momentum. It wasn't this super bearish character that we had through 2018 and super bearish character we had through 2021. So you can see that after our collapse here in May 2021, we've been trying to recover it, and we've only recently had a burst back above that yearly average. Now, that was actually triggered by FTX. So you almost have to wait and give it a bit of time to see whether this can actually sustain momentum. Do we get a bit of a 2019 style grind higher, or does this actually fail and fall lower? So in both of those instances, it's telling us something about the momentum of the on-chain activity, and that's really a bit of a proxy for what's going on in terms of demand and the user base. Now, on a very similar vein, we have our revenue from fees. This is a statistical model. It will be blue when there's basically no free pressure, and it will be red when lots of people are bidding for block space, get my transaction confirmed, and there's urgency imposed within that. So at the moment, you can see it's fairly lackluster. We had a very, very small uptick during the FTX collapse, but it's essentially gone back to basically no fee pressure. So this model is a great one to look for when we actually get that uptick and we start to see that fee pressure building. This will start to move back into the red zone. As it stands at the moment, it's pretty quiet, and we can essentially deduce that there's very little fee pressure at the moment. Now on the transaction volume, this is looking at on a USD basis, how much USD value is flowing through the network. You can see here's the bull market, and FTX collapses, and this thing is basically in free fall. It has fallen from somewhere on the order of 65 or $66 billion per day, and we are currently down here about $5.8 billion per day. So a very, very dramatic decline, pretty much immediately following. Well, there was a bit of a decline leading into, but definitely following the FTX collapse, a major washout. Now, what I want to do is quickly jump over to another chart. Now, this particular model is in our professional package, and what we're looking at here is the breakdown of transaction size as it relates to the amount of volume, right? So we're looking at $10 million plus transactions is in this dark blue down the bottom here. That's the one we're going to focus on in a moment. We've got our 1 million to 10 million, 100,000 to 1 million, and so on and so forth. But what you can really see is that the 10 million plus has a very, very similar profile to our change adjusted volume we were just looking at. Note particularly the collapse from about 42.5% dominance through most of 2021 and 2022. And we've seen a collapse down to about 19%. So more than cut in half the overall transaction volume associated with these $10 million plus entities. Now, there's kind of two key interpretations that I would take away from that. The first one is there's probably been a shaking of confidence but also just some serious losses sustained by institutions. They've seen what happened over the last year, and there is probably a bit of less willingness. There's been a shaken confidence. So those institutions are going to have to go through a whole process of re-understanding what's going on with this asset space and how it fits into their portfolios. The other one, as we've now found out, and as more things come to light, and again, this is a bit of a gray area, there was a lot of transaction volume going on that was associated with the FTX Alameda entity. And it is likely that a reasonable chunk of this had something to do with them. So since that entity is more or less out of the picture, we've seen a flushing out of that volume, and it's in a way probably returning to some kind of a more natural and realistic baseline. But again, all of these things take a lot more analysis, but they're kind of the two big takeaways that I certainly sense are leading to this collapse in whale volume in particular, but more specifically, a very, very significant decline in overall transaction volume. So what we're looking at here is the exchange inflow and outflow volumes for BTC and ETH. Obviously BTC in orange, ETH is in blue, and inflow volumes to exchanges is on the top side and outflows are on the bottom side. Now, generally speaking, we see a fairly evenly matched inflow versus outflow. There's obviously a net position that's slightly different between these two, but generally speaking, we see if there's $1 billion flowing in of Bitcoin, there's somewhere around $1 billion flowing out on any one particular day. They're generally fairly well matched. Now, what I want to really highlight here is how similar the pattern between 2017, this is the irrational exuberance. We come into the top, there's a whole lot of transaction and trade volume. Note also that Ethereum peaked following BTC. BTC was the first one to put the market high in, and transaction activity for Ethereum peaked after the top had already been established. And here we are back in 2020, 2021, we had the same effect. Bitcoin peaked, and then we had the explosive volume come in for Ethereum following that. Now, following both of these events, you see a significant decline, an overall compression, transaction volumes start to fall. You see less and less exchange activity. This is again getting us into that very quiet on-chain activity space, quiet volatility. The market goes into a bit of a sleep, but generally speaking, that precedes some kind of move down the line. Now, the other insight from this is the purple line. Now, this is looking at essentially the Ethereum dominance. Let's look at all the transaction volume that we can see on this screen. And what we're going to do is say how much of that is represented by the Ethereum chain. Now, as you can see, through most of 2020 and 2019, this was hovering somewhere between around 20-25%. Now, since the bull market came in 2020 and 2021, and particularly as we came into May 2021, this has really established a higher plateau. So we're oscillating somewhere between around 38 and 45% of all exchange activity is Ethereum relative to Ethereum plus Bitcoin. So we're only looking at the two majors here, but it does show that there's been a bit of a structural change in the overall market liquidity. And really the market is treating both of these as the two major assets within this space. And it's just one of those interesting market dynamics that we can start to observe over time. So it represents not quite half, but it is getting close. You can certainly see the dominance of the blue relative to the orange has expanded over the course of the last couple of years. Now, moving on to the Ethereum side. So Bitcoin is not the only chain that's seeing a very, very quiet on-chain activity space. We have much the same going on the Ethereum chain. So on the right-hand side, we can look at the mean transactional. This is the mean gas price paid. We are down at very, very low cycle lows. The last time we saw this was July 2021 after we had our first major peak and sell-off, and then back here before the bull market in 2020, so following the COVID collapse. So very, very light on-chain activity. There's not a great deal of sectors that are really booming at the moment. On the left-hand side, we're looking at the actual gas consumption broken down to different transaction types. And the one that I really want to highlight, most, whether it's DeFi, stablecoins are quite stable, strangely enough, in terms of the amount of gas consumption. Some are around 12%, if I remember correctly. DeFi and bridges and MEV, all of these that generally tend to peak during bull markets, they've actually been in a fairly long-term decline. Really, since around August 2021, we've seen a decline in all of these different sectors. The one that really was consuming much of that and exploding in overall activity was the orange, which is NFT trading volume. So we're seeing that NFTs really entered the scene July, August, September of 2021. They maintained somewhere around 25 to 35% gas consumption, we saw a significant decline down to around 20%, somewhere around November 2022. And following the FTX collapse and the kind of dust all settling, NFTs over recent weeks have seen an expansion back up to around 38% dominance. So what we're seeing is that most sectors are actually seeing less activity during this bear. The only exception to that, and only in recent weeks, has actually been the NFT space, which is starting to pick up a little bit more of that volume. So just again, one of these interesting structural dynamics that's occurring within the on-chain space. Now, the last topic that I want to touch on is the realized cap. So for those who aren't familiar, the realized cap is one of the most important and fundamental building blocks within the on-chain analysis discipline. Now, there are some challenges that we have with market cap. The problem with market cap is it values Satoshi's coins, which are long lost, as well as all the other lost coins. It values those coins at the spot price. Now, that's a little bit disingenuous because if Satoshi was to move and sell all those coins, it's very unlikely that spot price is going to stick around for very long. Likewise, there's other projects, and a great example of this, unfortunately, was the FTT token. And many of the tokens that were kind of within that FTX orbit, there was a lot of tokens that were vested or remained with the founding teams, but were never actually circulating. So what that means is that a very small proportion of the token supply can maintain what would be argued to be an inflated market cap. So when we're looking at things like market cap dominance or relative valuation, valuing all of those tokens that may not actually be liquid and circulating, like Satoshi's coins or like a protocol's treasury, or these coins that just aren't really part of the circulating supply, is a little bit, can lead to some, well, as we saw with the FTX disaster, people overvalue these tokens and then loans get issued against them, and it can create some havoc in the market. So what the realized cap does, the concept behind the realized cap is it will only value every individual coin at the price when it last transacted. So it's not perfect, but what it's doing there is it's picking up all those coins that we saw flowing in and out of exchanges. They're going to get constantly revalued at the current spot price. Let's imagine a world where Satoshi does wake up and spend his coins. They're going to go from a realized price of 0 to a realized price of whatever the current price is. So what we're doing is getting a bit more of a true transacted volume weighted average of price. So it also reflects the cost basis. What we're doing is we're looking at what is the price at which these coins transacted. And if we make a, high level assumption, and we can look at realized cap from a few different lenses, but if we look at the realized cap just as a very simple assumption, it's the last price they transacted. Let's assume that that's the cost base or the cost of acquisition, because for every seller, there's a buyer. So you're getting this transaction, this cost basis type effect. So it shows the real capital inflows. If a coin was acquired at 10,000 and then sold at 50,000, that transaction is going to revalue the coin higher. Someone else had to come in with $40,000 to buy that coin. Conversely, when you see coins go from 50,000 down to, 16,000, that delta between the acquisition and the sale price is a realized loss. So when you aggregate all this together, you both get a discounting of lost or unvested tokens. You get a tool that tries to volume weight where the cost basis is for the market. And the end result is a more accurate tool to compare assets. So these two charts are looking on the left, obviously at Bitcoin, on the right at Ethereum. You can see the realized cap goes through these almost stair-stepping patterns. There's a few insights we can take from this. Generally, this stair-stepping happens during bull markets. And if you can guess why, that's because all the folks who are buying coins down here in the bear market are selling for a profit. And those coins are going from 5,000, 6,000, 3,000, up to 50,000, 40,000, 30,000, 60,000. So the value of those coins, the transaction price is going up. People are realizing profits. Now, during a bear market, we've got here the all-time high in blue. You can see this pullback in the overall realized cap. These are people who bought at 50,000 and sold at 40, 30, 20, 16. So what we're seeing is the overall net change in the market valuation. So you can also see here in the red, we've got our drawdown, and you can see here where we are at the moment. This is 18.8% for Bitcoin. It is the second largest drawdown of the realized cap in history. You can really only compare it back here to the 2011 market. And for any of you who've been watching these videos for a while, you know that I generally don't pay too much attention to that early cycle. It was just too different to where we currently are. So in a way, in terms of modern history, this is the worst bear market we've ever seen. In terms of the overall realized losses, the drawdown of capital from the peak has been significant. Now, the other insight I want you to take away is note that the realized cap has essentially erased all of the gains that were made on the second pump, right? The second rally that we saw up to the November, October all-time high has been completely flushed out. All the profits that were taken during that period have been completely flushed out. So in a way, it kind of reflects a capital reset. We've seen that flushing out of the excesses and all of that extra speculation capital that came in on that second rally. We've essentially flushed all of that back out. And now we're probably approaching something closer to a more fundamentally driven valuation. Now, when we look at Ethereum, we haven't quite got the largest drawdown in history, but it's still it's 25 or 29.2% of the realized cap has drawn down. It's not quite as bad as what we saw here in 2018, 2019, but it's still pretty significant. It's much larger than we had back here in 2016, but same thing. Let's not compare too much to the old days. Now, the last thing I want to touch on, as we've established that the realized cap is probably a superior metric for comparing assets, this is just a very simple implementation of looking at market cap market dominance. You'll often see the Bitcoin dominance metric, and the challenge with the Bitcoin dominance metric is it's got all of the pitfalls of market cap that we discussed earlier. All of the tokens and all of the assets that may not really be fairly valued, and that includes Bitcoin, Satoshi's coins, and unmoved coins from the Ethereum ICO, all of these illiquid coins, it's not really fair to value them at the spot price because it's not a real representation of value and capital flow. So what this model is doing, when we're up at higher levels, it's showing that there is more realized value flowing into Bitcoin. And conversely, when it's at lower levels, we're seeing more realized value flowing into Ethereum. Now, this is just looking at the two major assets, but this same concept can be applied to all sorts of things. And if you were to run this particular model with a larger and increasingly large basket, you will start to see a bit more of an accurate representation of what's going on when it comes to true market dominance and where, importantly, the capital is flowing. Not so much what the price is telling us at the moment, but more so where is the true structural long-term capital flows moving around the space. Now, there are some limitations with it. If you're looking at privacy tokens, for example, we can't measure the transaction, how many coins were moved and when, so you can't apply the same heuristics. So there are some limitations to this model, but at the very least, just having an appreciation for the realized price and the realized cap and what it really means relative to the market cap will give you a lot of insight when it comes to on-chain analytics. It really is a powerful tool. It's a foundational element, and it really sets you up to understand more about what's really going on in this space. So thank you for tuning in for that session. I hope you did have a very refreshing break over the new year. I am looking forward to this series. It's going to be a really fun one. There's going to be lots of interesting topics. Who knows what the market's going to hold in front of us? And just a quick reminder, if you do get a chance, please do leave some comments on the topics and the ideas and the things that you want to hear about this year. If there's anything you're unclear on, you can always ask questions. And as I said, any information about whether you're a Glassnode member and how you're actually finding things, where I can best help you understand your edge, is really going to go a long way and help me shape this season. So until the next one, I will see you then. Cheers.